Barrick just authorized a $3 billion share buyback, and the market immediately framed it as a return of capital story. That framing is incomplete, and the incompleteness is where the capital opportunity lives. The buyback follows a quarter where net earnings tripled year over year to $1.6 billion, but gold production fell 5% to 719,000 ounces. Free cash flow of nearly $1.6 billion beat estimates even as output declined, meaning Barrick is generating more cash per ounce, not more ounces. That ratio matters because it tells you the buyback isn't funded by operational expansion. It's funded by gold prices doing the work a new CEO cannot yet claim credit for. Mark Hill was appointed CEO after Mark Bristow's abrupt departure in September, a management shakeup that created an institutional credibility gap at the exact moment Barrick needs institutional confidence for a major restructuring. A buyback signals that the board believes the stock is undervalued, but the statement Barrick actually made was more specific. It said the repurchase is timed in anticipation of the planned IPO of North American Barrick. That is not a return of capital rationale. That is a valuation management rationale. Barrick is buying its own shares now because it expects the spinoff to unlock value it believes the current price does not reflect. The $500 million buyback from late last year becomes the baseline here. The $3 billion authorization is 6 times that figure, executed in a window between a management transition and a structural corporate event. The size of the buyback is a signal about the size of the expected valuation gap, not the size of Barrick's confidence in gold prices, which at $4,823 per ounce realized in Q1 need no defense. What the buyback does not resolve is whether the spinoff itself will price at a level that justifies the pre-positioning, and that question leads directly to what goes inside the new company.
The North American Barrick spinoff is targeted for a 10 to 15% partial IPO by end of 2026, with a primary NYSE listing. The assets anchoring it are the Nevada Gold Mines joint venture, the Pueblo Viejo mine in the Dominican Republic, and the Fourmile discovery. But Fourmile occupies a structurally different legal position from the others. It is wholly owned by Barrick and is not currently part of NGM, the joint venture Barrick holds at 61.5% alongside Newmont's 38.5%. A preliminary economic assessment pegged Fourmile at up to 750,000 ounces of gold per year for at least 25 years. That production profile, sustained over a 25-year horizon, is not an incremental asset. It is the kind of discovery that sets the long-term production floor for an entire company. The pre-feasibility study isn't expected until 2028, which is why Fourmile was not planned to be vended into NGM for several more years. CEO Mark Hill changed that calculus when he said Barrick may reach an early agreement with Newmont to fold Fourmile into NGM ahead of schedule. His framing was conditional but directional. If we can reach an agreement, we would bring it in for sure. That sentence is doing significant work. Bringing Fourmile into NGM before the spinoff means it enters the new company as a joint venture asset rather than a wholly owned one. Newmont's 38.5% stake in NGM would apply to Fourmile, reducing Barrick's effective economic ownership of the discovery inside the spinoff vehicle. The counterargument, and why Hill is still signaling early entry is preferable, is that Fourmile inside NGM makes the spinoff far more compelling to institutional IPO buyers. A wholly owned undeveloped asset with a 2028 feasibility study is a longer-dated, higher-risk position. Fourmile inside an operating JV with Newmont as a co-owner is a de-risked, operationally integrated asset that institutional gold allocators can underwrite more cleanly. The hidden variable is Newmont's negotiating position. Newmont holds 38.5% of NGM and has every incentive to negotiate the entry terms of one of the century's greatest gold discoveries on favorable ground. The early agreement Hill referenced is not yet reached, and the terms of that agreement will directly determine what percentage of Fourmile's 750,000-ounce annual potential flows through to North American Barrick IPO investors.
Barrick has historically traded at a discount to peers like Agnico Eagle, and the conventional explanation is geographic risk, heavy exposure to Africa, the Middle East, and Pakistan. The spinoff addresses this structurally by isolating North American assets into a separately listed vehicle. Jefferies analyst Fahad Tarek said a material re-rating likely requires both the North American IPO execution and divestiture of assets in challenging jurisdictions. That qualifier, both conditions, is where the consensus view understates the complexity. The spinoff creates a new North American entity, but it does not change what remains in the parent Barrick after the IPO. The assets that drove the geographic discount, including the Loulo-Gounkoto complex in Mali, stay in the parent. Mali's situation has deteriorated. Russian troops abandoned a nearby military base following insurgent attacks, which raises the operational risk profile of an asset that was already geopolitically elevated. The spin-off does not neutralize that risk, it concentrates it in the residual parent while moving the premium assets into the new vehicle. This creates a two-tier capital flow dynamic that the market has not yet fully priced. The North American Barrick IPO will likely attract investors who specifically want stable jurisdiction gold exposure, the premium multiple buyers. The residual parent, now more concentrated in Africa and the Middle East, faces a more constrained investor base. The post-spin-off parent's re-rating depends not on executing the IPO, which is a one-time structural event, but on whether Hill can demonstrate progress on divesting the challenging jurisdiction assets after the IPO is complete. The $3 billion buyback executed before the spinoff is therefore most defensible as a mechanism to hold existing shareholders through the period of maximum structural uncertainty, the window between now and end of 2026, when the IPO terms, the Fourmile JV negotiation outcome, and the pace of geopolitical deterioration in Mali all resolve in parallel. The average realized gold price of $4,823 per ounce provides the cash flow runway to sustain that posture, but the re-rating the buyback anticipates is contingent on a Newmont agreement that has not been reached and a divestiture program that has not been announced. Whether Barrick trades at a premium multiple by the time North American Barrick lists depends on whether Hill closes the Fourmile negotiation on terms that preserve the spinoff's production story, and that negotiation is the only element in this setup that neither Barrick's cash flow nor the gold price can guarantee. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.